At 8:30 in the morning, Eastern Standard Time, 99% of retail traders are watching for a signal. They believe the non-farm payroll report will provide a clear direction, a logical path forward. What they are about to receive is not a signal. It is a weapon, a pre-programmed sequence aimed directly at the heart of human emotion and the predictable location of their stop-loss orders. Most traders see the market as a battlefield of bulls and bears. This is a fatal misconception. Around a major economic release, the market is not a battlefield. It is a meticulously designed abattoir, and the release of the data is simply the mechanism that opens the gate. The prevailing logic dictates that a strong economic number should send markets higher, and a weak number should send them lower. This logic is the bait. The lab's case study begins on the first Friday of the month. The asset under observation is the E-mini S&P 500 futures contract. In the minutes leading up to the release, the price action is anemic, coiled like a spring. Volume dries up to almost nothing. This is the calm before the storm, a synthetic tranquility engineered by institutional players pulling their bids and offers. To the retail participant, this looks like market anticipation. In reality, it is the deliberate clearing of a kill zone. High-frequency trading algorithms do not need to predict the economic number. They only need to predict the predictable reactions of the human herd. Their strategy is not based on macroeconomics. It is based on predatory opportunism. The clock strikes 8:30. The NFP number hits the wire. Let us assume, for this case study, the number is significantly better than expected. Consensus was for 180,000 new jobs. The actual print is 270,000. The headline is unequivocally bullish. The reaction is instantaneous. Within the first 500 milliseconds, the price surges 30 points. Breakout traders, programmed to buy strength, jump in with market orders, chasing the move. Their buying adds fuel to the fire. Simultaneously, the wave of buying pressure crashes into the dense cluster of sell-stop orders placed by short sellers, triggering a cascade of forced buying. This is wave 1, the deception spike. It is a manufactured, violent repricing designed to accomplish two specific objectives. First, to liquidate the short sellers. Second, and more critically, to entice a massive number of retail traders to take long positions at inflated prices, convinced they have caught the day's primary trend. They are wrong. But the real power of this algorithmic sequence is hidden in what happens next, in the silent moments after the initial chaos subsides. To understand why this explosive move is a trap, we must first examine the flaw in its core logic. The logic of the headline-reading human. The algorithm is not trading the news. It is trading the reaction to the news. The initial surge was driven by the fastest HFTs and the panicked reactions of retail. The larger, slower institutional money has not yet acted. They have no interest in buying at these newly manufactured highs. Their objective is entirely different. The 30-point spike was not a move to a new fair value. It was a liquidity generation event. Every trader who bought the breakout has now placed their stop-loss below the recent swing low. Every liquidated short seller is now on the sidelines, emotionally compromised. The market is now perfectly primed for the second and true institutional move. The deception is complete. The stage is set for the harvest. The volume from the initial spike begins to wane. For approximately 90 seconds, the price churns near the highs, a deceptive pause that gives trapped buyers a false sense of security. They see a consolidation, believing the market is gathering strength for the next leg up. The algorithm sees a completed objective. To understand why the market reverses with such violence, we must analyze the order flow data in the milliseconds following this pause. The initial wave of HFT buying vanishes from the tape. There are no more large aggressor buy orders. Instead, something more sinister begins to appear on the offer side of the book. It starts subtly, a block of 500 contracts offered for sale, then 1,000. These are not retail orders. This is the first signal of wave 2, the reversal. The institutional algorithms that created the initial spike are now distributing their long positions, selling them at a premium to the herd of eager breakout traders who are still buying the dip. This distribution phase is clinical and efficient. Once the algorithm's initial long inventory is offloaded, the program's second directive is initiated. The trap is about to be sprung. The selling is not passive anymore. It becomes aggressive. The same machines that forced the price 30 points higher now begin to hammer the bid side with overwhelming sell market orders. The price plummets. It slices through the entry points of the breakout buyers with terrifying speed. Their euphoria, which lasted less than 2 minutes, turns to disbelief, then to panic. Their stop-loss orders, clustered together in a predictable price zone, now serve as rocket fuel for the downward cascade. Each triggered stop becomes another market sell order, pushing the price even lower, faster. This is the true directional move, the one orchestrated by institutional capital. It moves in the opposite direction of the headline-driven spike. It is designed to capture the liquidity of those who reacted predictably, to prey on the very emotional responses that classic technical analysis teaches. The economic report was never the signal. It was the trigger for this pre-planned execution. The first spike was a lie, a carefully constructed narrative told in the language of price and volume. But the mechanism is even more complex than a simple pump and dump. The algorithm's efficiency is rooted in its ability to manipulate market sentiment on a microsecond timescale. The reversal is not just a liquidation of trapped longs. It is also an engineered signal for an entirely different set of participants. As the price collapses below the pre-news range, it triggers another class of algorithms, the momentum and breakout short-selling systems. These systems, designed to chase and accelerate trends, now act as a powerful afterburner for the institutional reversal, ensuring the liquidation of the trapped longs is as brutal and complete as possible. The entire cycle, from the peak of the spike to the break of the low, often takes less than 5 minutes. A perfect, symmetrical trap. But here's where the story takes a darker, more unsettling turn. What if I told you that this entire, violent, 90-second drama wasn't about the money made today? The profit from this single trade is trivial to the institutions that deployed this weapon. So why go to all this trouble? Why orchestrate such a complex, two-wave attack just for a 50-point reversal when they could move markets in simpler ways? The answer is chilling. The primary objective was not to capture liquidity. It was to inflict psychological trauma. The algorithm is not just trading price. It is actively programming human trader behavior. The real target wasn't their stop losses. It was their memory. Think about the trader who bought that breakout. They followed the news, saw the momentum, and made a textbook entry. 2 minutes later, they were wiped out. The pain of that loss, its speed and its violence, creates a powerful, lasting, emotional scar. This scar, this trauma signature, is now a predictable data point. The algorithm has successfully installed a new fear into a statistically significant portion of the retail market. The fear of buying a strong news-driven breakout. And that was the real prize, because now, the machine knows exactly how they will react next time. The next time a major economic report sparks a powerful rally, the herd of previously burned traders will hesitate. They will remember the sting of the V-top. They will wait for a pullback, for confirmation, convinced it's another trap. This is Wave 3, the conditioning exploitation. The algorithm, having successfully conditioned the herd to fear the breakout, now executes the opposite pattern. It engineers a genuine, sustained trend, knowing that the very traders who would normally fuel it are now paralyzed on the sidelines by the memory of the last trap. The institution can now accumulate a massive position with less public competition, riding a cleaner trend fueled by the eventual panic buying of those who get left behind. The algorithm didn't just win one trade, it won the next 10. It wasn't just harvesting liquidity, it was cultivating fear. And that fear is the key to its ultimate long-term strategy. But what if the humans, the retail traders, were never the primary target at all? The true target was never the human mind. It was the mind of another machine. The psychological conditioning of the retail herd was merely the forging of a weapon of inaction, a denial of liquidity attack aimed squarely at a larger, slower, more predictable institutional rival. This is algorithmic warfare. The rival system, operating on older quantitative models, expects the human herd to behave predictably, to chase momentum, to provide the exit liquidity. Our algorithm's devastating masterstroke was not in creating an action, but in creating its opposite, a pre-planned, synchronized moment of mass hesitation. When the rival system went to execute, it found nothing. The liquidity it counted on, the foundational assumption of its model, had vanished. It was left exposed, its own orders moving the market against itself, trapped by an enemy it couldn't see, using a weapon it couldn't comprehend. The V-top, the failed breakout, the subsequent sustained trend, these aren't just trading patterns anymore. They are feints, provocations, and flanking maneuvers in a war fought in microseconds over the core logic of the market itself. The billions of dollars changing hands are just the collateral damage. And you, the trader sitting at your desk, are no longer just a participant. You are the terrain. Your fear of a reversal, your greed for a breakout, your panic as you liquidate. These are not your own emotions. They are carefully calibrated munitions. Your collective hesitation is a shield wall. Your collective panic is a battering ram. The ultimate prize in this war isn't profit. It's something far more valuable. Predictive supremacy. The ability to not just forecast the market, but to write its future. To control the underlying sentiment so completely that your rival's every move is a predictable error. To transition from being a player in the game to becoming the architect of the game itself. The question is no longer, what will the market do next? But what have they programmed you to do next? We are living inside the machine. The logic of the market is no longer driven by balance sheets and economic reports, but by a hidden layer of code that actively manipulates our own. To navigate this new reality, to even begin to protect yourself, you must first understand the architecture of your prison. We're here to give you the schematics. Subscribe to trade_logic_lab, and we'll show you how deep the code goes.